So markets are at an all-time high, and it's a really uncomfortable time to think about investing in a new stock, in a new company, because you look at those all-time highs and you think, well, there's got to be a crash coming, right? There has to be some bad news that's going to cause a decline from here, right? You feel like you're overpaying. It's really difficult in times like this, I think, to find a good company to invest in. The answer, though, is always the same, which is to find a value stock, right? A great company at a reasonable price. Put your money in and let it work for you, because at the end of the day, the old saying is true, right? Time in the market beats timing the market. Even though we're at all-time highs and really you think the prospect for a broad crash is maybe a little bit higher, the odds are a bit higher, I think it still makes sense to invest. Like, we still have to be looking for those new opportunities to either invest new cash or to rebalance a portfolio and pick up a new stock. So I'm constantly doing that all the time, and I thought this was probably a good time to make a video about exactly that, because there's two companies that I'm looking at: United Wholesale Mortgage, UWMC, and Rocket Companies, ticker symbol RKT. And so, I think what I want to do here is I want to take a look at the fundamentals of both of these companies. I have a really systematic way of doing this. I have a ranking system that I use that ranks and compares stocks head to head on a number of different metrics. And so I'll get into what those are in the video, and I'll show you why I think either one of these companies is better in one particular area. And then stick around to the end, because at the end I'll do an overall comparison, right? And I'll add up all of the various scores that I've come to in these different areas and come to an overall analysis of which one I think is the better deal. Okay, so we're going to take a look at the company stories for both of these guys, and if you're familiar with either one of them, you'll probably know that they are both fintech companies, and really the fintech value proposition is all about taking that really archaic business model that banks and insurance companies and finance companies have, and trying to add additional value to it, to either increase the value they're delivering to the customer, or to reduce expenses by making things more efficient and streamlined, and thereby making a lot more money, right? And the financial industry seems like it's really a good candidate for this type of disruption, because it is so old, it's very paper-based, the service is not great. There's a number of different reasons why fintech makes sense, and so both of these companies are in the business of trying to disrupt that legacy model and make a bunch of money in the process. Okay, so first up, let's take a look at UWMC, United Wholesale Mortgage Corporation. These guys were a private company up until about January of this year, and they went public via one of these SPAC deals, these special purpose acquisition companies. It was the biggest ever SPAC deal at the time, at around $16 billion. Now, these guys do wholesale mortgages, which means that they don't have a direct retail presence. You can't walk in and get a mortgage with them directly. Instead, they will sell their mortgages through a network of dealers and brokers. And so essentially their customer is the mortgage broker that you'd walk into, to either get a new mortgage or to refinance your house. And so they're all about the tools, the processes, the back-end support systems that these brokers and dealers need in order to manage their own business, right? And then they actually originate and sell their mortgages through those channels and enhance the businesses that these folks, the brokers and dealers, are in with all of these back-end tools. That's their value proposition. That's really who their customer is. And so really that's where the wholesale bit comes from for this particular company. And they're doing really well at this. They're the number one player right now in wholesale lending. They have 34% of the market share, and it's a really, really significant market. They're in a really good spot. Now, Rocket is different, right? Rocket is actually in the retail mortgage business. They don't have this wholesale relationship with a network of brokers and dealers. They are originating and selling mortgages directly into that retail market, and they're doing it through a web presence, right? That is their fintech disruptor, which is the unique web-based tools, the web portal that folks can come into, and they're really streamlining the process of uploading documents and the application process and fast approvals and all this kind of thing, and also supporting data and additional content that people are interested in when they're in the process of refinancing or looking for a house. They're trying to pull people in to that model and that ecosystem. And the other value proposition that they're into is basically the cross-selling of this new home buying paradigm that's being pushed a lot, which is they're trying to sell you all the additional ancillary services at the same time, you know, home inspections and appraisals and insurance and all the things that new homeowners or refinancers are interested in. Rocket sees that opportunity to sell those things directly to those retail customers as well. And I'll say too that it's important to understand that Rocket and the Rocket companies are actually part of Quicken Loans. Quicken Loans is one of the largest mortgage lenders in the US. They have some of the best rates and fees available in that market. So they're a really, really strong dominant player, not only in their own, but also as part of Quicken Loans itself. Okay, now there's an economic story that's really important to understand here too, right? So there's some broad factors that are impacting both of these companies right now, and none of the news is really good. You know, I think there's broad agreement that we're coming off of a refinance high and a new home acquisition high based on stimulus highs in the lending market. So that has happened. That news is in, and basically we're coming off of that wave, right? So the earnings that we're going to see in both these companies are probably going to take a hit into the future as that cyclical business sort of enters a trough. The market knows this, and the stock price of both companies has suffered as a result of that. And you know, I talk about cycles, right? And really the mortgage business itself is cyclical. A lot of people believe that we're entering the start of a multi-year low in terms of mortgage origination cycles. And if that's true, both of these companies are again going to see earnings stagnate for, you know, who knows how long. It's not a great story for the stock price. And if all that wasn't bad enough, you know, there is upward pressure on interest rates, or at least interest rate expectations. You know, the Fed is going to have to taper at some point. There's inflationary pressure out there. Everything is telling us that interest rates are only going to go up. It's really difficult to believe that they're going to go down at this point. And so that is going to further decrease lending activity as folks are a little bit, you know, less interested in refinancing or mortgage origination as rates are climbing, right? It tends to really dampen that particular market. Not only that, there's additional pressure coming from other players in this market, Loan Depot and Zillow. You know, there's not just these two companies looking to play this fintech disruption in the market. There's a lot of other folks that are doing it, and they're doing a really good job of it, right? So you look at this whole situation across the board, this economic backdrop, the competition out there, the whole interest rate thing that's happening, and it's no wonder the share price of both these guys have suffered a lot. But really the good news for us as investors is we need to take a look at that and say, well, gee, maybe this is a good time to buy, right? Has the price gone down low enough that there's a deep value play here? Is all the bad news in? And is our downside risk limited because the price has already gotten to a level where this business is really, really attractive for both of these companies potentially? I think that might be true, and that's why we really need to dig into the fundamentals of these guys and see which one is better and try to make a buy decision. Okay, so I said in the intro I have a system for doing this. I use a platform that you've probably seen in some of my other videos called Portfolio 123. Fantastic software on that platform. They allow you to build these ranking systems, and you can actually rank and compare stocks based on criteria that you define. Some of the broadly used criteria that are available on the platform have to do with four things I really like, which are quality, value, growth, and sentiment. I like to take these four different things. I like to use them to slice into the data in a company, analyze them head to head, and see which one is better. And that's what I'm going to do here in this video. Okay, and first I'll say quickly what those things are, right? So quality is about the health of the underlying financials, the numbers, you know, we're talking about revenue and debt and all that kind of thing. Growth measures how fast a business is expanding, both in terms of sales and earnings growth and dividends if they pay dividends. Sentiment looks at how investors feel about the stock. It takes into account things like short interest, number of analysts that are covering the stock, the change in analyst recommendations, and a number of other things that you can actually quantify with respect to sentiment. And value, of course, is the price that we actually have to pay for the earnings stream or the assets that a company has. And so that's basically it. I put all these things together. We can dive into each one, and then we can sum the whole thing to come up with a ranking or a score to try to quantify what would otherwise be a fairly subjective decision. I like to really put a number and a score to these things. Okay, we'll switch over to Portfolio 123 here, and we'll pull up the first one, which is our quality metric. And so, basically the way these scores work is you pull together all of these different factors, right? So we can look at gross margin, operating margin, net margin, some of the debt measurements, return on assets and equity. All of these things can be quantified using the underlying data that the companies report, and we can see which one scores higher in each particular area. And then down here at the bottom, you can add all of these up and you can see which one is the winner. And right here we can see that Rocket is in fact a pretty clear winner. And if you take a look at why that is, really it has to do with the return on equity and the debt efficiency that Rocket is able to pull in here. And that really goes back to, I think, the retail model that these guys are into. So the cost of sales for individual customers that come into that retail platform is really low. They have an efficiency to be gained there. And basically the bigger they grow, the more revenue they're going to have in at a lower cost of acquisition. So they don't need to take on as much debt. If you compare that to UWMC, it's a completely different business model. Cost of sales, cost of acquisition is higher. They need to spend more time, money, resources to sell into these brokers and dealers, and maintaining those customers is difficult. The cost of building out platforms that are more specific to the requirements that these guys have in different jurisdictions and things like that is higher. And so their efficiency, their actual return on margin is inevitably going to be a little bit lower. Doesn't mean they can't make as much money in the long run, but in terms of the numbers that we measure here on a quality scale, we're typically going to see better numbers in more of a retail play, and that's why Rocket is absolutely pulling ahead in this one. Okay, so now if we flip over to value here, the value ranking takes into account the typical metrics that we look at in any company on a value scale. We look at PE, the price to earnings ratio, price to sales, another popular value metric, price to book, price to free cash flow, and the actual enterprise value. So, there's not a lot of wiggle room in these numbers. They're very, very clearly defined, I guess. And here we can see again that Rocket is the better deal on pretty much all of these metrics, really. And really, I think it has to do with that PE number, right? So if you take a look at this 8.38 PE for Rocket, that seems ridiculously low. I think that Rocket is a screaming deal if you look at it just from a PE perspective, which a lot of investors do. And I think, the richer valuation, at least in terms of PE that UWMC has here, is enough to make you think twice, really, about whether this is in fact a deep value play. I would have to say it's not compared to Rocket. Rocket is clearly the winner here on a value basis. Okay, now we'll take a look at the growth tab here. Growth is measuring basically sales growth, both over the trailing 12 months, so EPS growth in the past and EPS growth projected into the future. And we do the same thing on sales, right? We can take a look at what it was and what we think it will be, or what the analysts that are covering it think that it will be. And here the two are pretty evenly matched, right? And really the reason for this is that both companies are fairly new in terms of the numbers anyway, right? In terms of their ability to report on their current business models, both are fairly new. And so we can't get a really great sense of what the growth was. The growth metric is further obscured by the craziness that happened in 2020 and also in 2021, I think. So really it's hard to draw any sense of what the growth will be in the future based on what it was. It's really a guessing game, especially with all the change that's happening in the economic backdrop, right? With all of this stuff going on, making any kind of prediction on growth for either of these guys is super difficult. And in any event, it's a wash here. There's no clear winner on the growth side. Okay, now we'll take a look at sentiment here, and I think I mentioned in the intro what sentiment measures. It has to do with the analyst recommendations, and not just the recommendations, but also the EPS revisions that the analysts have, right? Are they revising those upward because they think the company is going to do better than expected? Are they pulling them back, So we can actually measure this using the data that's available here in the platform on Portfolio 123. And if we take a look at all that and measure that up, from a sentiment perspective, at least on the data points that we can measure, it seems like Rocket is a pretty clear winner here as well. And, it has to do with those EPS revisions. I think that the analysts have slightly better expectations go forward for Rocket. And certainly, I think that there's some consensus here that makes sense given the number of analysts we have. There's 14 folks covering Rocket. There's 10 folks covering UWMC. So these are well covered stocks. I think there's a reasonably good consensus across the analysts here that Rocket is in fact the better deal from a future earnings potential. So there's a little bit more excitement, I think, on the analyst side behind Rocket than there is for UWMC. Now, you can argue that this is actually a contrarian indicator in terms of sentiment, and I think there's some basis for that. But in any event, if we look at it, what it is right here, the analysts have it in favor of Rocket. Okay, now, the numbers can't tell the entire story. I think we have to also consider a few other factors. There's a couple of unique things here that I think are playing into the situation. UWMC, I mentioned, is a SPAC company. They went public through this reverse merger type of thing. That whole industry of SPAC mergers was an absolute bloodbath over the last several months. There was a huge amount of hype, and then the hype crashed. People were running at top speed away from anything that had a SPAC label attached to it. And I think UWMC got caught up in that SPAC hangover, or the fatigue that was associated with that. There was a lot of buyers, I think, that were into UWMC that fled, basically because they were pulling out of SPACs entirely, both on the retail and the institutional side, right? I think everybody was doing that. Rocket, on the other hand, it was a bit of a victim of the meme stock trade, I think. Earlier in the year, that excitement has faded a little bit for Rocket, so I think some buyers, probably liquidated and pulled out as a result of that. So both companies have this sort of artificial inflation of the stock price and then a subsequent decline, right, due to different factors. But that's happened on both sides, and I don't think either of those things had a lot to do with the fundamentals of the company, right? It was just the inevitable hype cycle that came in here. Now, another thing I'll point out that is a little bit different is UWMC pays a nice dividend. I think the yield's around about 5.5% as I record this. That's really good. It's a lot higher than the average dividend stock, in the US market that folks are going to buy. There's a whole crowd of dividend-focused investors out there that love UWMC for that particularly high dividend. There's a lot of folks that chase yield. And when they do, a new company with a lot of growth potential behind it that pays a fat dividend, that is absolutely going to attract and has been attracting buyers that are dividend focused. I think as the price has declined, there's only more folks that are coming in that are hungry for that yield, that are going to be bidding up the stock price of UWMC go forward. So there's a whole dynamic there that is not at play for Rocket. Rocket, on the other hand, does not pay a dividend. They're a new company. They're more of a growth stock. They're an easier story, I think, to understand from a growth scenario. So they're definitely a pure capital gains play. I think that's attracting a different type of investor that then would ordinarily go after a stock like UWMC. So different crowds of buyers, different businesses, different companies here with these guys. Okay, so how can we wrap this up? Well, you look at the numbers and clearly on all four of those metrics, except, the one that was a wash, it's pretty clear that Rocket is the winner. It's the better value play. And to my mind, I think Rocket is the safer investment because of that value metric. It's really hard to imagine a scenario where we could see a huge price decline from here at a PE of under 9 for Rocket, unless something really fundamentally bad happens to the business, right? So given that, I think that limiter on the downside is super attractive for Rocket right now, because like I say, with the markets at an all-time high, we're looking for that downside protection or cushion against a bear market decline or a correction. I think that is a really key attribute of Rocket that makes me want to buy that one. On the other hand, I think if you're more of an income and dividend focused investor and you want to play in this space, you want to capture a piece of that mortgage growth, then yeah, UWMC is a no-brainer, right? Because the dividend is also really nice protection against a broad market decline. If you believe that dividend is safe, I tend to. I think that UWMC's dividend is very solid. It's based on a stream of locked-in mortgage products. So yeah, I think that in a decline, you're going to be able to continue to recognize the income from that 5.4% dividend yield. So that provides a margin of safety as well. But I think you'd have to accept that there could be a significant price decline from here, given the fact that their value score is not where Rocket's is. But that can be misleading too. And I think we have to always look at a total return standpoint. And to my mind, I think that Rocket is not only safer, but I think they have a higher potential for total return. You know, the growth story is not well reflected in the numbers, but I really like the growth potential that I can see in that sort of retail model. I'm less convinced that the same growth can be seen on the wholesale model. So just given that from a total return standpoint and that margin of safety on the price side of things from a total return standpoint, I'm quite a bit more excited about Rocket here than I am for UWMC. If I was buying one of these today, personally, I'd go out and buy Rocket. And that's it, guys. Thanks so much for watching. Please give that video a thumbs up and stay tuned for the next one.